Let's take a look at putting Grand Prix Granite company, setting them up and doing some transactions using Sage50 as opposed to the QuickBooks. Here is our Word document that lists out our items, and you may want to have printed this out so that you can easily see it as we go through this video, or keep it on a screen where you can easily see it. All right, Sage50 has an icon. The current icon is a round orange icon with bars, but it still has this arrow that goes up on it. Okay. When Sage50 opens, just like with QuickBooks, if you were working previously on a particular company, that company is going to automatically show up on your screen, and you will have to say File and Close. So here I have shown up on Glow-Brite Paint Company, which was the last company that I was using. So I'm going to say File and Close. If you have not yet worked on a company, then automatically you will come to a screen that looks something like this. The Sage50, also previously known as Peachtree, and I use both of those terms back and forth. This version is an educational version from 2016. The version that you may be working with may be 2018, 2019, 2020, and so, but they're all fairly similar. You should see a screen that looks like this pretty much. It will have a button to open an existing company. This is only for those companies which are saved on your hard drive. If you have not saved any companies on that computer's hard drive, there will be nothing to open here. You can create a new company, which is what we're going to do in this video. You can explore a sample company. They have 2 samples, unlike QuickBooks that has lots of different sample companies. They have 2. Bellwether Garden Supply does retail, and they do some services. And then Stone Arbor Landscaping, which only does services, and this shows their time and billing features. And so you can go into one of those and play around and practice. Okay, but today we're going to create a company for Grand Prix Granite. And this will help you with project number 8. Okay, so I'm going to click on Create a New Company. And we get a screen that tells you what type of information you're going to need. So you're going to need the company name and address. You're going to need to know what business type it is, meaning is it a sole proprietor, a partnership, or a corporation. Most of our projects are sole proprietors, but you would have to know that. The accounting method, cash or accrual. We recently did project 6, in which we discussed the difference between cash basis and accrual basis. This is not something that you can easily change, so you can't just pick one and hope that it's right. You need to know this company is a cash or accrual basis. Most of our companies are accrual basis, but Project 6, which also leads into Project 7, is a cash basis company. Accrual basis of accounting is required by GAAP, and GAAP by law must be used for all public companies, and typically if a company is big enough to get bank financing, the bank will require the accrual basis of accounting because it's GAAP. generally accepted accounting principles. The cash method is used on small private companies that don't get bank financing or get very minimal bank financing. The IRS does allow you to do the cash basis of accounting to do your tax return. So there are some companies that do use the cash basis, but you will have to know before you create this company. The accounting periods, so how many accounting periods? Some companies have different ways of their accounting periods, and we'll discuss that when we get to that screen. And the fiscal year, sole proprietor must, by law, have a fiscal year that goes from January 1st to December 31st, the same as the calendar year. But a corporation might choose to have a fiscal year that's different. They want their fiscal year to end when their lowest point of inventory. So if you were JCPenney or something like that, your lowest point of inventory might be the end of January, the end of February. So you would probably want your fiscal year to say go from March 1st to February 28th. And you could do that. You would have to set that up with the IRS, etc. Most of our companies for our projects are sole proprietors, so they cannot have a fiscal year other than January 1st to December 31st. Okay? Now here there's only one required field, but actually there's two because the business type is defaulted to corporation. So most of ours are sole proprietors, so you will have to use that as well. So this is Grand Prix Granite. You want to put your initials in. And this is a sole proprietorship, so you want to click on that. In real life, of course, you'd put all the rest of this, these ID numbers, the federal employer ID numbers, and all these addresses, etc. It does say at the bottom you can edit this information after your company is created, so if you want to just put in the minimal amount and move along, you can do so. We'll hit on next. This is the various ways that you can add the chart of accounts. Adding the chart of accounts in Sage 50 is a zillion times easier than QuickBooks. QuickBooks assumes that you do not know anything about accounting, and it wants you to take your QuickBooks to an accountant and get your company set up. Then once it's set up, then it tries to be as easy as possible for you to actually do the transactions on it. But it does not want you to set it up, so it makes it difficult. Now, with Peachtree, it assumes that you do know something, and so it allows you to set up the company a lot easier. However, that means that if you actually don't know anything, you could make a royal mess out of your bookkeeping. Now, it is, they do have use a sample business type that closely matches your company. And they got a bunch of different business types. And it will give you an entire chart of accounts, not just the income and expense suggestions like QuickBooks, but it gives you the entire assets, everything, for that sample of company. And if you have a company in real life, that's probably the easiest way to do it, to choose one of those samples and then modify it as necessary until you get it to look like yours. However, for our project, since we just have such a small amount of accounts, it's so much easier to use this bottom one that says build your own chart of accounts. You can also copy settings from an existing Sage 50 company. So if you have several companies that you've set up in QuickBooks, you can then just use that other company and transfer their chart of accounts into this new company and then just modify it as necessary. So that would be another easy way to do it. Well, we're going to build your own chart of accounts. It says design for accountants. Of course, you all are accountants, so this is good for you. Okay? And we're going to say next. Now it wants to know whether we're accrual or cash basis. And note on the bottom, it says, note this cannot be changed after your company is created. So you have got to know what basis of accounting you're in. Now, most companies are on the accrual basis because whether they have to because of law or whether they have to because of bank financing, and it tells you that this happens when income is recorded when a sale occurs, regardless of when you actually receive the money. So if we mow Mrs. Smith's lawn at the end of October or the end of August and we don't receive the money till the 1st of September, then we're going to record the income when the sale occurred. That means when we did the job, which is August. It will be an August sale, and we will debit accounts receivable. Then in September, when we actually receive the money, we would debit cash and credit accounts receivable. But the sale, the income, the revenue is recorded when that sale actually occurs, when we actually do the job or deliver the product. The cash basis, on the other hand, income is recorded when you receive the money. So in that case, we would wait till September and debit cash and credit sales in September. Okay? All right. So in this case, for Grand Prairie Granite, it is accrual basis, so we will leave it on accrual basis, and we'll click next. This is where you can choose a posting method. QuickBooks doesn't have this option. Peachtree or Sage50 is a more powerful program, and it gives you more options for things. Real-time posting means each transaction is posted. As soon as you enter it and you click save, boom, it puts it in the journal and it posts it to the ledger immediately. And that's the way QuickBooks does it. And this is the way we normally work, even in Sage50. If, however, you are doing 100 invoices and you want to go back and forth and fix things and get them all the way you wanted and then post them all as one giant group at the end, after you've got them all done, then that's called batch posting. And with Peachtree, you have that option to do batch posting if you wanted to. Of course, here in Accounting 240, we do not have that many transactions in one batch, so we do not need to do this. And the note at the bottom says that you can change the posting method at any time. So if you want to go back and forth between these two methods, you can. Okay, we'll leave it on real-time posting. We go to next. Now it wants to know accounting periods. And again, this gives you another option that QuickBooks does not give you. Most companies have 12 monthly accounting periods. So January is one monthly accounting period, February is another period, March is another period, etc. Even if you have a fiscal year that goes from March 1st to February 28th, then March is your first monthly accounting period and April is your second accounting period, etc. Okay? But there are some companies that do not match the calendar months. And so their fiscal year ends on the last Saturday of December or the last Thursday of March or whatever, something like that. And so this year, the last Thursday of March is the 29th, and last year, the last Thursday of March was the 23rd or whatever. So if you have an accounting period that is like that, you can do that in Peachtree and you cannot do that in the QuickBooks. So you could just bubble that. Now, we don't have any of our projects like that, so you can just leave it on the 12 monthly accounting periods for us. Here's choose the first period of the fiscal year. We've talked about this multiple times during the class. If it is a sole proprietorship, by law, it has to have a calendar year. It cannot have a fiscal year other than January 1st to December 31st. And so the first period of the fiscal year is going to be January if it's a sole proprietor. If it's a corporation, it might be a different month, and you have to know when is the beginning. So if it went from March 1st to February 28th, then you would put in March as the beginning of the fiscal year. Okay? Note, this cannot be changed after your company is created. So you would have to start over. If you say, oh, the transactions for Grand Prairie Granite are in April, so I'll put in April as being the first period of the fiscal year. And then you go on, you do your transactions, and then you find out everything is totally messed up and you have to start over. So this is not the first period of the transactions. It's the first period of the fiscal year, and it must be correct. Okay? So January is it. Okay? And so we go on. Okay, you're ready to create your company. Notice that this had far fewer questions for you to set up the company than QuickBooks did. Okay, this tells you that you can only use the company for 14 months and then, you know, it will delete because this is the student version. Okay, it is creating the shell of the company inside the hard drive of this particular computer that I'm working on. Just like QuickBooks, if I want to save this company file, I have to do a backup. And then if I'm putting it onto some like flash drive or something, then I have to do a restore to bring it back up. I do not do a save as and an open except for reports. The actual company file has to be done as a backup and a restore unless you're only working on the same computer and you're using the same hard drive. Well, then you don't have to do anything. It's all right there. All right, this is a setup guide. It tells you, you know, step by step, and it's saying the first thing you need to do is the chart of accounts. Okay? You don't really need this, but if you would like this, you can keep it. Okay? I'm going to click Don't Show This Screen at Startup and then say Close. Okay? All right. Now, your screen may look slightly different, the way that the buttons are, but they're still basically the same buttons. Sage50 always opens on the customers and sales. Here's our various things that we have, windows that we have, and it always opens on customers and sales by default because most companies, that's their most common transaction is sales transactions. So this is the screen you're going to use the most, so it defaults by opening to this screen. Now we need to do the chart of accounts. There's various ways that we can get to the chart of accounts. One of the easiest ways is to go into banking and then choose the chart of accounts, and we're going to choose new account. Okay, we have to give an account ID. So if I take a look at Grand Prairie Granite, here's my chart of accounts. There's my account numbers and the account name, and then a beginning balance of those accounts. Now, unlike QuickBooks where we had to do a multiple step process to be able to get our chart of accounts in, here we're going to put the whole thing in, account by account, right from the start. So we're going to start with this checking account and move on, okay, through the rest of the accounts. Okay? And then once we have all the accounts set up, then we'll go in and put our beginning balances in. So our first one is account 1020. That's the account ID, is the account number. Okay. Notice I didn't have to go into edit preferences and tell it to use account numbers. You can use whatever you want as the account ID. You can use a name, a word, or you can use the numbers. Okay. Numbers are the most common account IDs. okay? And checking account is the name of our cash account, okay? So the account ID is the 1020 number. I can also, in Peachtree, I can click on enter and it'll go to the next box. If you do that in QuickBooks, it kind of ends that whole screen, okay? And so you have to use tab. You have to either click your cursor into the next box or you have to use tab. You can't easily use enter, but here I can use enter, tab, or my cursor to get to the next box. Now the description is the actual name of the account, which is checking account. Okay, and then there's the account type. Just like QuickBooks, there's a variety of different account types. Okay, and here are all their account types. Now there are some few differences. In QuickBooks, we set up an account type called bank. You had to set up a bank account. Here, it's called cash. So, but it's the same thing. It's your checking account, or any bank account would be set up as a cash type. And then you'll be able to do bank reconciliations, etc. And here you want to say, we do not need to put in account beginning balances yet. We'll get all our accounts set up first. Okay, so we're going to go up here and say save and new. Okay, we'll put in the next account, which is 1100, and that is accounts receivable. Now in QuickBooks, if you hit a beginning balance of a customer, then you do not set up accounts receivable. Once you set up the customer's beginning balance, automatically QuickBooks would set up an accounts receivable account for you. So if you ended up setting up one too, then all of a sudden you had duplicate accounts receivable accounts. Here in Peachtree, you set up the accounts. They're not going to set up an accounts receivable account for you. You need to set it up, and then we'll go in and set up the customer and their beginning balance. And you just want to make sure that your beginning balance of your customers equals the account beginning balance when we put it in for accounts receivable. Okay, the account type is, they have a separate type for accounts receivable, then they know to keep track of all the customers and how much each customer owes. Okay, and we'll say save and new. The next account is inventory, account number 1200. Okay, and there's a separate type for inventory as well. And then that way it knows that we're going to be tracking inventory. Okay, and we click save and new. The next one is account 1500. And that's our equipment. And just like QuickBooks, that's a fixed asset. And we click save and new. And then we have 1501. And that's accumulated depreciation. Oops. DPR-equipment. Okay. Now, unlike QuickBooks, they have an actual type for accumulated depreciation. In QuickBooks, you would have to put accumulated depreciation as a fixed asset, and then you would have to put its beginning balance in with a negative, with a minus sign. Here they have a separate type for accumulated depreciation, so you will not need to use a minus sign. They'll already know that this has a credit balance because it has its own type. Okay, then we'll say save and new. Okay, the next one is 2000, and that is accounts payable, and there's a separate type for that, and save and new. Our next one is 3000, and that's Milton Grand Prix, comma, capital. Now, there are several different equity accounts. There's an equity doesn't close. You would use that for the owner's drawing account. So if this is MG-drawing, comma, drawing, then we would put it under equity doesn't close. Under equity gets closed. This is an equity account that's going to close out at the end of the year. And a drawing account, a withdrawals account, does get closed out at the end of the year. So we would use equity gets closed. If this was a corporation and we had common stock and paid-in capital in excess of par, those are equity accounts that never close out, and we would use those. Now, no matter what you have to have an equity-retained earnings account. This account is where the net income that we close at the end of the year, we close it into income summary, and then we close it from income summary into the capital account if it's a sole proprietor, or the retained earnings account if it's a corporation. So regardless of whether you have a sole proprietor or a corporation, you need an equity-retained earnings account. This is where everything is going to close to. It will not let you go forward with transactions until you have set up a retained earnings type of account. And for us, that's the capital account, is the retained earnings type of account. And we say save and new. Okay, in this case, we don't have an owner's drawing account, so we'll go on to revenue. Okay, and that's sales. And just like QuickBooks, the revenue is called income instead of revenue. Okay, save and new. If you had sales returns and allowances or sales discounts, they would also be called income. Even though they're contra revenue accounts, you would then have to use a negative to put those beginning balances in. In this case, we don't have those. Next is our cost of goods sold. Okay, and they have a special type for that. They call it cost of sales. Our next one is 5,300, and that's our purchases discounts. Okay, this is a contra cost of goods sold account or contra expense account. Okay, and so we're going to use cost of sales, but we'll have to use a negative sign when we put in the account beginning balances. Okay, save and new. And we have 6,500, and that is rent expense. And that is an expense. Okay, and we can save. Okay, and now we've done all of our accounts. We can now put in our beginning balances. It wants to know what is the period before you start putting in transactions. No, be sure to enter your beginning balances before you start entering transactions. Now the transactions on our sheet here are April. Okay, and so we're going to use March is the month before our month of transactions. Okay, so we'll choose March. Now that's March of 18, and we want March of 19, and we're going to say okay. Okay, now up pops this box, and notice that it has all of our accounts listed, what type the account is, and then it has a debit column and a credit column, and the white box where we put the number is already set on the proper column. If we know that that balance is supposed to be the opposite of what the white box is, we put in a negative sign. Now cash is an asset, so it has a debit balance, so I can, and it's already on the debit side, so I can just put in the 10,000. And again, those are beginning balances coming up from there. Okay? Here's accounts receivable. I'm going to put that amount in there, is 4,000. Here's inventory, and that's 14,000. Here's equipment, and that's 50,000. Here's accumulated depreciation. Notice it's already on. It already knows, since it has its own separate type, it knows that this is a contra asset and that it has a credit balance. So it's already on the credit side. We do not need to put a minus there. And so this is 23,000. Accounts payable is a liability. It has a credit balance, and that is 10,000. The capital account is 32,000. Sales. Now remember that the fiscal year starts in January. Our transactions we're putting in are April. So that means we've had 3 months of business already go on. January, February, and March. So it's allowing us to put in sales and expense accounts. If we were putting in January transactions and it knows that the company closed out in December, the sales and expense accounts wouldn't show up because they were already closed at the end of last year, and we don't have any new sales yet. Okay, so in this case we do have sales, and we can put that in. That was 50,000. Our cost of goods sold is a debit balance. That's 35,000. Now here we have purchase discounts, which is also listed as a cost of goods sold, but it is actually a contra expense account, so it should have a credit balance, but the box is on the debit side, so I'm going to have to put a minus 1,000. Okay, rent expense is a debit balance, so I don't need a minus. Okay, now my total for my debit side is 115,000. My total for the credit side is 115,000. The trial balance is 0. If you have a number here under trial balance, your debits don't equal your credits, then it says if you just go ahead and click OK, it's going to post that difference to beginning balance equity, and you will have to fix it at some point. It refuses to post anything until the debits equal the credits. So it's going to stick your difference into beginning balance equity. You want to make sure that that is 0, okay? Or else you're going to, if I see beginning balance equity on anything you give me, then I know you didn't put your beginning balances in correctly and there's points taken off. Okay? All right, so in this case, everything looks good, and so we're going to say okay. Okay? And then we can, we can go into reports. And here we have a chart of accounts report. It shows us all of our chart of accounts, the numbers, the name, and what type it is. So you should go through this, make sure everything is how you want it to be, okay? And if it is, you could print it out. If I wanted you to submit it, notice there's a PDF and an Excel button up there that you can save it to your flash drive or whatever using those buttons. Okay, we'll close out, and now we're ready to put we put our beginning balances in, so we can also go into reports and down to general ledger. Okay, we have some sort of problem here, and so will have to reopen. Okay, rather than waiting for this, I will just finish telling you, you need to get up your trial balance. You need to get it up as of March 31st. Make sure that all the beginning balances are the way that they look on your sheet, and that everything balances and looks proper. And then at that point, you are good to go. I'm going to finish this as part 1, and then in part 2, we'll set up our inventory, our vendors, our customers, and do our transactions.